Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we'll have a look at global inflation and we'll touch on US, Chinese, and European inflation in particular. We'll also have a look at what's happening with regards to US commercial real estate. We'll look at the performance of US quality versus growth versus value over time. And we'll do a review of the medium-term budget policy statement that came out last week. We're going to start off with global inflation. Global inflation is unchanged at 2.5%. We've had inflation prints for 37 of the 50 largest economies. What's interesting about the latest inflation data is that more than 50% of countries have seen inflation surprise on the downside. And this is the third month in a row where more than 45% of countries have seen inflation surprise on the downside. So in effect, we've got a situation where inflation is steady, but that's a better than expected outcome. If we look at China as an example, Chinese inflation has actually ticked up a little, but it's at 0.2%. That's still pretty low, and there's ample scope for further stimulus from the Chinese authorities, and we'll show shortly there's probably some need for stimulus with regards to China too. If we look at Europe, European inflation ticked down from 2.2 to 2.1%, so pretty much in line with the ECB's target, and there's little need for them to change rates anytime soon. Our base case is that rates will remain unchanged in Europe for the foreseeable future. The US is a little different. We don't have an inflation print for the US for October, and we're unlikely to ever get one based on commentary from the White House. The difficulty is you can't go to shops and try to get an idea of what prices were 2 or 3 weeks ago. And given the shutdown, the BLS was unable to sample prices at the time. So we're unlikely to get an October inflation print. The best estimate is that inflation at the moment is 3%. We expect that it's going to continue to be at around 3%. And that's a bit above the global median at 2.5%. And it's not often the case that US inflation is above the global median inflation rate. Now, the gap at the moment is still quite small at 50 bips, but given the tariffs in the US, this could well mark a divergence. And the difficulty for the Fed then is that we'll end up in a situation where US inflation is high relative to the rest of the globe. That means that monetary policy lands up more restrictive in the US relative to the rest of the globe, and that is a knock-on consequence for growth. Our expectation is in that environment, even though interest rates in the US would be higher than we're seeing elsewhere, it would be bad for the dollar because growth would be weaker. So this is an important series to monitor. We will update on a monthly basis. At the moment, we've just seen a small gap open up, but should it persist, we expect that ultimately it would lead to some degree of dollar weakness. And just on US inflation, there is some upside risk to near-term numbers. Given the surge that we've seen in natural gas prices, US natural gas prices are up around 20% over the last month alone. Natural gas is very important for electricity generation. Electricity generation clearly very important for the economy at large. So this is another series we need to monitor very closely. Should this series remain at these levels, we would expect that it's going to be upside to US inflation and upside to US inflation forecasts. Switching to the US stock market, the S&P 500 currently trades on a 12-month forward P of 23.5. That's a 45% premium to forward PEs for the rest of the world. That's also about a 30% premium to the S&P 500's own 20-year history. So whichever way we look at it, relative to peers or relative to history, the US stock market is looking pretty stretched. And one could say that that's because of earnings growth, which has been pretty good, above 10% year on year. Or it could be because of the strength of the US economy. But even so, a lot of good news is currently priced into the S&P 500. In fact, it does at this point look like it's priced for perfection. Now, if we look at the long-term history for the US, the best performing factor in the US has been quality. These are companies with stable and predictable return on invested capital, companies that are typically not very geared. Companies like that over the last 30 years have materially outperformed both growth and value in the US, but not lately. And there's been an interesting turnaround. While quality would have outperformed materially over the past 30 years, of late, we can see that there's been some degree of underperformance. And in fact, the underperformance of late is the starkest that we've seen in 30 years. Over the past 6 months, quality stocks, US quality stocks, have underperformed the S&P 500 by 11%. And that's not necessarily because of quality stocks performing poorly. What's happened is we've had a very narrow rally in the S&P 500, driven in this case by growth stocks. And the extent of the outperformance of growth versus quality over the past 6 months is the largest that we've seen in 30 years. It is quite remarkable, and that's what's led to the extended multiple, and that's what's led to the US now trading at the largest premium that we've seen in the past 20 so years relative to peers and relative to history. Just looking at another component of the US economy, commercial real estate, office vacancies continue to tick up. They're now just a bit above 20%. What we need to watch for is commercial real estate delinquencies. Now, that series is still pretty low. It's been inching up. It's sitting at about 1.5%. But this is a series that we will update on a quarterly basis. It is a risk for the US economy at the moment, given still very low delinquencies. It's not material, but it is something that could be material in time, and we do need to keep a close eye on it. And speaking of series we need to keep a close eye on, the key leading indicator for the Chinese economy is total social finance. We've had another weak print. The series is now down about 14% year on year. The 3-month average is down 14% year on year. We also saw a decline in money supply, and we've also seen a range of other indicators with regards to construction and the housing market that have been pretty weak as well. So we now have a set of indicators suggesting that the Chinese economy is due a soft patch over the coming few months, short of some form of stimulus announcement. And there is space for a stimulus announcement. So we'd expect to see something like that coming quite soon. If we don't, we're going to have to revise our expectations for the Chinese economy, and as a result, revise our expectations for commodity prices. And finally, in South Africa, we had the medium-term budget policy statement come out last week, and it was significant in 3 respects. Firstly, there was an adjustment to the inflation target. The SARB had already been acting as though there was an adjustment to the inflation target. What was significant about the announcement is that it was an indication that the adjustment should be gradual over the next 2 years, and in addition, there's a band around 3%. 1% above and 1% below. And that's a bit more flexible than the guidance from the SARB prior to this. And as a result, there's scope for a rate cut as soon as this week. The consensus forecast is for a 25 pip cut on Thursday, and that's a pretty sensible view given the medium-term budget policy statement. The second is an expectation that debt to GDP will peak this year. And whether it peaks this year or next year, the point is that we're pretty close to the point at which debt to GDP peaks, and subsequent to that, we should see it decline. And that's a momentous occasion. We've seen many years of increasing debt to GDP in South Africa, and to reach the turning point is quite exciting. The third point is that even with all the forecasts and the good news, and the budget was received very well, we still think some of the estimates are conservative. The growth number for this year we think is conservative. The revenue forecast for this year we think is conservative. So there is still some upgrades to come, we think, come the budget next year. But even prior to those upgrades, on Friday, S&P upgraded South Africa's debt. And if we look at what's currently priced in, what's priced in by the market is for further upgrades. The market is pricing another 1.5 upgrades from the rating agencies over the coming few months. Now, to get to investment grade would require further upgrades beyond that. And the market's not pricing that in. Should the market price in investment grade for South Africa, that would mean, in effect, at this point, a further 50 basis points, or 0.5% reduction in our bond yield. So potentially, should we continue on this path and debt to GDP actually does decline over the next few years, and we do see further upgrades, and we land up in investment grade, we would expect that to translate to about 0.5% reduction in our bond yields in South Africa, which is quite meaningful, especially when you consider that bonds have done a hang of a lot over the past year already. And finally, just on currencies, over the past year, the rand has strengthened by about 6% versus the dollar, which is quite good. But when one considers that the dollar itself has weakened by 7% on average across currencies, we can see that over the past 12 months, all of the rand strength, in fact, has been due to dollar weakness. But it has been a tale of two halves. Initially, for the first 6 months of the last year or so, the rand was actually relatively weak. But over the last 6 months, it's actually strengthened quite materially, strengthening by about 5%. And the dollar only weakened by about 2% of that period. So over the last 6 months, we actually had some SA-specific rand strength, which is what led to the rand being just a bit below 17 on Friday. So where do we sit now? If we look at the rand relative to history, based on an inflation-adjusted, trade-weighted currency, the rand is still relatively weak, and the dollar is still relatively strong. So even though the rand has done a lot over the past year, and the dollar has weakened a lot over the past year, based on the trade-weighted, inflation-adjusted currencies, there's scope for more to come. And that's where we're going to end it this week. That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.